You know what's funny about the really big stories in money and power? They rarely explode with fireworks and viral scandals. Most people were checking stock tickers, sipping their morning coffee, or doom-scrolling headlines when a quiet interview clip from the Oracle of Omaha just flipped the script on who's really pulling the strings behind America's political comeback. No red carpets, no leaked memos, just a 94-year-old billionaire dropping truth bombs in a way that could reshape how we see the intersection of wealth, elections, and influence. And if you're wondering why you should care, let me put it simply. This affects your taxes, your retirement savings, the rules of the game for every business from startups to giants, and how much sway a handful of ultra-rich folks can have over the policies that touch your daily life. So let's break down exactly what happened, why it matters, and what comes next in plain English without the Wall Street jargon. Here's the situation in one sentence. Warren Buffett just called out the tech billionaires and old god tycoons who funneled hundreds of millions into Trump's 2024 resurrection, warning that their quiet cash infusions are turning democracy into a billionaire's playground and hinting it's bad for the long-term health of the economy we all rely on. The clip came from Buffett's latest sit-down at Berkshire Hathaway's annual shareholder meeting in May 2025, where he was asked about the record $2.6 billion poured into the election by just 100 billionaire families. Let's just call it the shadow donor network. And essentially, he said, hold on a second. That's not what free markets were designed for. Think of it like this. Imagine your neighborhood poker game starts with everyone chipping in $20 for fun. Then one guy shows up with a private jet full of chips, buys the table, and starts rewriting the rules mid-hand because he can afford to outlast everyone else. Your buddies are going to say, that's not what we started this game for. That's basically what Buffett did here. The system for political funding has been around in its modern form since the 2010 Citizens United ruling, almost 15 years ago. It's a Supreme Court decision that unleashed super PACs and unlimited corporate spending, giving billionaires special lanes to influence elections without direct coordination. We're talking about freezing out competitors with ad blitzes, sanctioning policy shifts through dark money, responding to immediate threats to their empires like regulations or taxes. The key word is balance, and not whenever it suits the high roller, not when you want to crown a winner. Emergency lever. Throughout its history, big money political giving has been used for a targeted, specific plays. Flooding ads against a single bill that hikes capital gains, propping up allies in key races, countering foreign influence ops, addressing specific immediate threats to bottom lines, but using it to bankroll a full-scale presidential comeback with over $570 million from just a few dozen tycoons. That's not balance. That's a takeover. The man looked at that and said, this isn't competition. This is capture. And there's a difference. We're not talking about small poker chips here. This was a staggering haul that propped up Trump's war chest, outpacing even the Democrats' billionaire brigade despite more of them jumping in. Elon Musk, the Tesla and SpaceX kingpin, who we trade ideas with every day through his apps and rockets. Miriam Adelson, connected to us through her casino empires and pro-Israel lobbying where bets cross borders multiple times before becoming policy wins. Oh, and the old oil barons like Harold Han, love them or hate them. They're deeply embedded in how American energy and jobs operate. These donations were part of what the donors called the Great Realignment, a sweeping push to bring back deregulation, tax cuts, and trade wars by making opposition voices more expensive to amplify. The problem, Buffett said, you can't remake the entire political economy by declaring your wallet an emergency and bypassing the little guy. Here's what makes this commentary so important. It's not really about whether Trump deserved the win or if the donors are heroes or villains. Buffett didn't say, I think these guys are terrible people with bad motives, That's not his game. Investors don't pick policy winners. They spot market signals. What he said was, "I don't see where the system gave you permission to drown out everyone else like this. This is about fair play, about how power is supposed to work in America. This is about the Constitution, about how influence is supposed to flow in America. The founders baked in checks on moneyed interests through elections and representation. Now, sure, the courts have delegated some of that to super PACs for specific situations. They can say, hey, in certain high-stakes races, you can act quickly without waiting for grassroots bucks. But, and this is crucial, that delegation has to have real limits. Buffett found that the way Citizens United is being used creates what he called an unbounded flood of power. In other words, it gives a tiny elite essentially unlimited authority to reshape elections however they want just by declaring a cause. That violates a fundamental principle. Power in America is supposed to be divided, checked, and balanced by broad participation. No single club should be able to restructure the entire voting map without meaningful oversight from the rest of us. Let me paint you a picture of what this means for actual companies. Imagine you run a startup that relies on green energy subsidies. 6 months ago, a handful of oil billionaires like him dumped $20 million into super PACs to kill those incentives. Suddenly, your funding dries up. You have 3 options. 1. Pass the pain to customers who might bail. 2. Absorb it yourself, torching your runway. 3. Lay off your team or scrap the pivot to stay alive. You choose option 3. You cut jobs. You hold the big hire. You scrape by. Then Buffett pipes up. Actually, that kind of donor dominance isn't sustainable for the market. It warps incentives. Now what? You might see policy refunds, potentially billions flowing back into innovation. That cash could refuel your growth. You could rebuild that team. You could chase that moonshot again. But there's a catch. The commentary isn't binding. Pushback is coming. Nothing is certain yet. So you're stuck in limbo. Do you plan for the donor flood staying? Do you plan for reforms kicking in? Do you overhaul your lobbying or wait it out? That uncertainty, that's what founders hate most. You can plan round tough regs. You can adjust to subsidy cuts. But when you don't know if the game's rigged for the whales 6 months from now, that's when things get brutal. Here's where the story takes an important turn. The donor class immediately clapped back, with Musk tweeting within hours that Buffett's out of touch with real innovation and Adelson's team issuing a statement on legacy versus future in plain English. The money stays flowing for now while the debate simmers. Think of it as hitting the pause button on reform. Buffett said, "This donor surge is warping things." The tycoon said, "Hold on. Don't crimp our voice yet until we counter this." So right now, today, the super PACs are still active. Companies are still navigating their sway. Nothing has rolled back. But the philosophical foundation underneath those mega gifts is shaky. Everyone knows this could swing either way, and that uncertainty is creating ripples through every boardroom and venture pitch in the country. Buffett leaned on an investing principle that's becoming increasingly important: the long-term value doctrine. Here's the idea in simple terms. If a move has enormous economic and societal consequences like tilting elections with unchecked billions, the market should price in the risks, not just the short-term wins. It's like the difference between your VC approving a $50,000 prototype versus a $5 billion buyout. Some bets are too big to make without broader buy-in. Buffett said these donor holes have vast ripple effects. They affect millions of jobs, trillions in policy shifts, the price of innovation, America's edge in global talent wars, decisions that big require explicit guardrails from Congress or the courts. You can't just stretch a 15-year-old ruling to cover something this massive without safeguards. If you're an investor trying to value a tech firm, This clip just added a whole new variable to your spreadsheets. Let's say you own shares in a company that's heavily exposed to regulatory whims. Yesterday, you were modeling their future cash flows based on donor-backed deregulation sticking. Today, you have to factor in, what if Buffett's right and reforms hit? What if antitrust probes ramp up? What if Congress caps contributions? What if this drags into 2026 midterms? Every one of those scenarios spits out different outcomes. And when you can't nail down which path wins, you bake in a higher risk premium. Higher premiums mean lower multiples. Lower multiples mean stock prices tick down. We've already seen some of this in market reactions. Not a meltdown, nothing Armageddon level, but nudges in sectors like clean tech and fintech. Firms most tied to policy flux are seeing their valuations wobble as investors recalibrate. And this will keep unfolding as the donor wars play out. This isn't the first time a sage investor has pushed back against unchecked elite influence. Back during the Gilded Age, folks like J.P. Morgan's rivals called out the robber barons for buying senators outright, saying the trusts had gobbled too much power without antitrust limits. Teddy Roosevelt was furious. His whole square deal strategy was built on breaking those monopolies. When the courts and public said no, it threw railroading and oil into chaos. Eventually, some trusts got busted with clearer regs. Others restructured, but a key principle stuck. Even in booms, even when big money moves fast, there are limits to how much sway one group can hold. This Buffett moment echoes that same vibe. He's saying, yes, donors have real pull, but no, that pull isn't infinite, and the boundaries matter. Here's something people aren't talking about enough. This commentary affects America's competitive edge abroad. If you're a foreign innovator or rely on US markets, you just learn something key. American policy threats or promises might not be as ironclad as they seem when they're donor-dependent. If global players think these billionaire bets might face backlash, does that weaken the US pitch at the investment table? Maybe they hold off on deals. Maybe they think, let's see what the oracle influences before we commit. That's a real knock-on. It's not just about domestic drama. It shapes how the world views American reliability and openness. For decades, the FEC and courts have let super PACs handle the heavy lifting on funding. The thinking was, money moves fast. Donors can pivot quick. Congress would just gridlock in partisan sniping and fund nothing. So, the system delegated and stepped back. But this Buffett nudge is basically saying, if you want this level of sway, spell it out explicitly. You can't let vague old precedents stretch to eclipse small donors. That means Congress might actually have to legislate. They might debate caps, hold hearings on transparency, vote on reforms. Some cheer that. Big call should run the Democratic gauntlet with public scrutiny and horse trading. Others see gridlock fodder. Congress agrees on zilch these days. How do they pass donation overhauls? But that's the setup we inherited. And this Buffett take is saying, lean into it. Don't hack on it. Let's zoom out for a moment and talk about why this matters beyond just donors and dollars. The framers split power for a reason. They didn't trust any one faction moneyed or otherwise to run unchecked. Over the past decade, really ramping up post-Citizens United, there's been a slow creep of billionaire leverage in politics. Tycoons from both sides have tested the edges of what they can buy without full disclosure. Sometimes it's vital. Real crises demand swift backing. But the trap is when emergency funding becomes the everyday tool. Gifts meant for pivotal races morph into routine kingmaking. And when that hits, the balance tilts in ways our system wasn't built for. This Buffett clip pushes back on that drift. It says, no, you can't treat elections like a private equity buyout. Influence has to stay exceptional, regardless of how you feel about these specific donors. Having voices like Buffett willing to call limits on elite sway is tonic for the market. The million-dollar question: where does this go from here? Clearly, the debate will percolate. This could bubble up to more media grillings, possibly even congressional probes if the midterms heat it. In the meantime, flux rules. Some PACs might throttle back during scrutiny. Others double down. Firms will decide without full visibility on the funding landscape in 6 months or a year. As for Congress, if they want to codify these flows, they might need to pass disclosure laws explicitly greenlighting them. That means the full sausage making, debate, amendments, votes. The donors might adapt. They could route through different channels that weren't spotlighted here. They could craft philanthropic vehicles that dodge scrutiny. They could lobby for exemptions that fit Buffett's fair play standards. Multiple roads ahead, multiple endings. And until clarity drops, everyone hustles in the fog. Important to grasp, this Buffett riff is narrower than some hot takes claim. He didn't torch all big giving or say billionaires can never back a cause. He didn't judge if Trump's comeback was good or bad for stocks. What he did say is this specific surge under loose rules doesn't build lasting value and needs tighter congressional nods for holes this huge. It draws a line on one vein of influence. Other funding pots stay open. Donors still wield big sticks under varied statutes. This isn't the death of super PACs. It's a curb on how far one unchecked wave can go. If you're sizing up your portfolio, here's how to frame it short term. More haze, more swings. Tougher to forecast donor-driven policy. Sectors exposed to regulation like renewables or pharma face extra volatility, so their prices might discount that. Short term, I've got more uncertainty, more volatility, harder to predict how funding flows will shape policy. Companies tied to donor whims face amplified risk, which means their valuations might compress. We've seen it long term, potentially more resilience. A market where icons like Buffett enforce real limits, where sway is checked and balanced, where no cabal can hijack the board unilaterally. That's a steady arena over time. He sucks now, but structural integrity, the nod to limits, to process, to value over volume, that's gold for enduring holders. Warren Buffett has always preached he bets on American enterprise because America has durable guardrails, investors who call bubbles, a playground of laws, not just of fat wallets. This clip, even with its near-term jitters, bolsters that. America's markets still self-correct. Limits still bind. Sway remains hemmed by wisdom. And that's worth a premium, even if it's tough to model. Here's the thing about guardrails. They're a drag when they slow your lane, but they're vital for keeping the road intact. If you're a donor chasing wins, ticks like Buffett's great. They gum up the works. They spawn complications. They drag you into disclosures and debates. But if you're a founder plotting growth, or an investor compounding quietly, or a voter who wants the game not gamed from the top, guardrails rock. They breed predictability. They block wild pivots that nuke everything. They route big calls through open channels with real vetting. Yes, that slows the sprint. Yes, that muddies execution. But it also steadies the ship, makes it trustworthy, more durable. And over decades, that durability underpins every bull run. We live in an age of hype reels and outrage bait. Every scoop spins as apocalypse or apotheosis. Grey fades, backstory vanishes, but the core here is dead simple. Once you slice the spin. 1. Buffett flagged donor floods warping a field. 2. The tycoons pushed back and the cash keeps pumping pending review. 3. The endgame will redefine sway for future cycles. 4. Meantime, businesses and holders navigate more fog. 5. The arena is hashing a clash over equity and limits. Not Armageddon, not utopia, not the demise of giving or the dawn of purity. Just the system doing its thing, with stakeholders voicing rules, disputes airing through discourse rather than dictate. If you're still here this deep, you're probably musing, all right. But what hit my wallet? Valid ask. Here's the rub. First, if you're a founder or exec, donor haze round policy is thicker now. Scenario your models. Don't bank on endless deregulation, but don't bet on caps either. Build a jewel. Second, if you're investing, outfits vulnerable to funding-fueled regs carry more beta. Price that in, but over horizons, a field with Buffett-style checks is actually more compound-friendly. Third, if you're in a trade-sensitive gig like manufacturing or tech, your stability links to this tussle. Donor wins might lock in protections. Pullbacks might sting others. The fog itself bites hardest. Fourth, if you're a citizen tuned to the machinery, this tests if our framework still hums, if markets self-regulate, if influence faces friction, if equity holds some sway. And so far, it does. The discourse could stretch months, maybe into 2026. Here's the probable track ahead. Next few months, more interviews and op-eds unpack it. Donors file counters, media deliberates as potential upsides. They amplify the call, sparking reform pushes. They dismiss it, cash flows with firmer footing. They hybrid it, remanding for finer scrutiny. Or if it's seismic enough, the Supreme Court might weigh in on a related case. That layers on more months, maybe another year. Meantime, the counter keeps funds active. Businesses grind under present rules awaiting light. Bottom line, brace for no snap fix. These cycles churn slow, until final wood. We all play with partial maps. Here's something that slips under radar amid the instant partisan froth. Resilient frameworks outlast any one donor derby. A nation where sages like Buffett can flag imbalances, that's a robust nation. An arena where leverage faces real reigns, that's a dependable one. A polity where voices check each other, that's bedrock for enduring growth. You can split on whether these specific gifts were savvy or suspect. You can debate trade policies or tax tweaks. Smart folks land everywhere on those. But no matter your lean, root for a setup where clout earns its keep, not just cashes its check. Giant calls demand legit backing. Markets enforce real reigns. No lone pack can reroute the river solo. That's not ideology. That's ecosystem fitness. And fitness is what turns a powerhouse into a perennial. If there's one nugget to pocket from all this, it's this. Horizon up. The now is choppy. Funds are fluid. Pushback pens. Swings are bound. Markets tweak. But the enduring tale is whether America's frameworks still flex, whether self-corrections still click, whether value still trumps volume. And per this Buffett beam, per his readiness to tag limits, even on peer power, per the arena methodically mulling this rift in measured talk, the nod is yes. The frameworks function, the reins hold, the equity endures. That's not splashy. It skips the screamers, but it's massively material because, bottom line, that framework vigor, that fealty to reins and rhythm and reins on club, that's what lifts enduring powerhouses from the pack. And that's the true thread here. Past the gifts and the gripes and the prompt pings, the arena's alive, and that's pricier than most clock.